Hey, it's Robert Slayton. A lot of people stressing over very large renewals this year. Yes, they're very large for a lot of companies. I want to give you 5 different areas where you can manage the cost of your insurance and also the cost of your benefits. And we're going to do it over a series of 5 videos. I do consulting. I also manage employers like a traditional broker. We have hundreds of companies across the country. So let's get started. First off, let's understand how risk plays into cost. So if you're on a fully insured plan, you're prepaying for claims that may or may not happen, okay? And then from there, if you take on some risk, intelligent risk, I'm going to have a swoosh that I'm going to show you right now. So this is just a ballpark. We've had it be dramatically more than what this says, but fully insured, if it's a cost you $1, then what you can do is if you can move from fully insured, maybe raising the deductible, and then layering in a health reimbursement arrangement or a medical expense reimbursement program. They're very similar. You're going to save maybe 7%. That's significant. That's a lot of money if you think about it. And then from there, if you take on, that's taking on some risk, right? So here's the base plan. You're taking on a little risk because you know that the vast majority of people will never use all of it will never have major claims. And that's where the beauty of this comes in, because if a person has a major claim, it's just that $6,000 total out of pocket or $9,000 out of pocket, but you only have 1 out of 20 hit that. Well, you have 19 out of 20 where you promise to pay and you get to keep the money. And so it's pretty cool. If you don't know what a health reimbursement arrangement is or a MERP, talk to us. We can help you. From there, you go to level funded, right? And what does that mean? Basically, you take on more risk. It's a standard plan. It looks exactly the same from an employer's point of view, from an employee's point of view, same card, same network, no issues. The difference is that the cost of the benefits or the cost of the plan is based upon the health of the group. If the group is generally healthy, you're going to save some money. Oh, and by the way, it's broken underneath into risk buckets. You have your administrative cost, and then you have a reinsurance cost, and then you have a claims bucket. And the beautiful thing is you only pay for claims. Anything that's left over, you get part or all of the money back at the end of the year. So one of our clients got a check for $32,000. They only have like 20 employees. That's a big windfall for them, and their net cost of their insurance for 2025 is actually lower than it was in 2024 if you take the $32,000 into account. That's what that means. And the other nice thing is you get visibility into what the claims are so you can manage it better. And we're going to talk about how to manage the cost of claims, the severity and frequency of claims in a future video. From there, you can move to a coalition. Captive is another name. Typically, this is for larger groups where you pool the reinsurance fees together and you save money. So you don't pay for the full reinsurance fee, but you have a group reinsuring one another on this lower level. And then you have a very, very high reinsurance, like $1 million and above, and you save money overall. And there's some other structures in there which help to reduce the costs. And then self-funded. Level funded and self-funded technically are the same. The difference is self-funded. You're not prepaying that claims fund. You just pay as you go. And that's for companies typically 250 on up, 2,500, 25,000. That's the way it is. And if you do self-funded right, oh my goodness, you can literally have your costs stay flat for years at a time. There's a right way and a wrong way to do it. I explain all of this in my book called The Healthcare Manifesto. It's on Amazon. It's an Amazon best-selling book. Just look for it, and it'll explain what I'm doing with these next videos. And finally, you go to direct contracting or reference-based pricing. This is reference-based. Typically, the reference is Medicare, and it pays a percentage of Medicare, maybe 130, 170%, even 200% of Medicare, because on regular network, so a regular network in the Chicagoland area usually pays 263 to 350% of the Medicare rate. So if you pay 200%, you de facto saved all that money. And a lot of times you can do direct contracting with hospitals or doctors and just pay a lot lower, and they're okay with it because you put in some structure so they don't have to chase the money. You just pay them and everything works out. So that's video one. So step one is see how risk pays a part, and it's intelligent risk. You don't take all the risk on yourself. You reinsure risk over a certain period of time, over a certain point. You have an individual stop loss, you have an aggregate stop loss attachment point, and you go from there. If you have questions, reach out to me. If you want a 20-minute strategy session, call my executive assistant, Jessica, at 800-913-2378. She's at extension 103. Thank you.